Okay, chapter 17, investment and business brokerage. In this chapter, we're going to explain the advantages and disadvantages of investing in real estate. We're going to describe the tax benefits of real estate investments and the effects of New Jersey Uniform Commercial Code. This chapter is talking about, we're going to be learning a lot of investor lingo. Okay, that's not necessarily just used for real estate, but we're going to learn about some of the lingo that could be used in investing in anything. But we're going to also learn about tax breaks and tax write-offs and such like that. So, what are the advantages of investing and using real estate to invest? Well, to generate some sort of a return on your investment. Using borrowed money, that's called leverage. When you use someone else's money for your investment, that's called leverage. Better to risk someone else's money than your own. It's leverage. It's also a smart thing to do to get tax write-offs. If you guys ever read or listened to Robert Kiyosaki, Rich Man, Poor Man, or Rich Dad, Poor Dad. Sorry, that's the name of the book, not Rich Man, Poor Man. Rich Dad, Poor Man was his book. Or The Art of the Deal by Trump, or other investors. But if you can watch a lot of videos from Robert Kiyosaki on YouTube. He posts a lot of videos there. And a lot of time, all of these investors, all these rich guys, these rich investors, the ones that are giving the classes out there or just teaching you stuff, they just post videos on YouTube and stuff for people to watch. They tell you, I even showed you guys a video called Money is Debt, right? Money is debt. There's such thing as good debt. And Robert Kiyosaki, if you ever watch any of his videos, look him up on YouTube. How money gets its value, which there's good debt and there's bad debt. And if you notice one thing, a lot of these rich people, they don't own anything outright. They try not to own everything outright. They like to have leverage, because then you could write off the interests on your taxes and have tax deductions. If you pay it off and you own it outright, you're just paying taxes on a property. And you own it outright, it's an asset, and you can get taxed based on your assets values and such. If you don't own things outright, there's debt on it still, you have loans on it, you can write the interest off of that on your taxes. There are tax advantages. Look up the Robert Kiyosaki videos. There's actually a course too that I took. The Real Estate Commission, there's mandatory training seminars that real estate instructors have to go to, and every couple of years. And sometimes they'll have a guest speaker that gives a class to give us something of value to get out of it. I actually recorded one and I made it available for you guys. I usually don't mention this one in class. I forget to, but I actually recorded this. And let me see if I can pull it up and share that with you about getting all kinds of tax write-offs. This guy is actually a former professional baseball player, but he was a mathematical genius. And this guy ended up, writing a book and having doing investment seminars and stuff like that, and telling people how to get the most write-offs from their real estate investments. And he does so through bifurcation. Basically breaking down how you don't just get one simple write-off on your real estate. It could be more involved than that, and you could get a lot more write-offs on your taxes for your real estate investments. So let me try to pull up my browser window and get to that. Let me minimize this for a second here so it's not in my way so I could pull up the what I'm looking for here for you. And it's a shared Google Drive. Close. All right, so when I open it up, well, actually, I think I put together a standard email for this already. Yeah. Open that in 1 second here. I got a template here for tax write-offs. Let's see. I just got to find it. I got a lot of standard emails that I have here. Let's see it. Right in front of my face. I'm not seeing it. I don't have it as a template anymore. I must have deleted it by mistake, but I know I sent it to classes before, so let me search it through my emails and then I'll share that with you. So, wow, it was a while ago. I took that. Get the details of everything. Took that in 2014. All right, let me pull this up. Give me a second. Let me pause this recording. It's worth showing to you. Okay, so I sent off to you guys the information for that tax seminar. I'll actually put all that info in a in the slideshow too. Let me get a copy of that again. I don't put the tax seminar info. Investors. DDD. We'll get a slide here for you. Create a new slide. Tax seminar for investors. So I'm just sharing this information with you guys on a slideshow now. We're just creating a slideshow for you here. Okay, so I put together another slide after this that has the same info that I sent to you guys. All right, so other classes will be able to get this automatically too. Now, the advantages are there's a return on your investment to invest in use real estate as your investment vehicle.
We can't see your screen.
You can't, okay, thank you. There you go. All right. So just to recap, and let me make sure I'm recording this. Yes, okay. So the advantages of using real estate as the investment vehicle to invest in is you get a return on your investment. To get leverage, that's using borrowed money to invest, and using inflation as a hedge. Basically, you hold on to the property, you hold on to that property, and using inflation property values fluctuate. They go up and down. So when it goes up, that's a time for you to sell, right? You buy low, sell high. And you could use that inflation as your hedge for making money too, by selling it when the prices are high. The disadvantages to using real estate as the investment vehicle is that it's not highly liquid, meaning that you usually can't buy it one day and sell it the same day or the next day or even the same week without taking some sort of a loss. So it's not highly liquid. You can't sell it quickly without taking a loss, unlike an investment in stocks or bonds where you could buy them and sell them relatively quick and still make money off of them. You have to wait for real estate has to increase in value either through inflation or through improvements that you do. So it requires expert legal and tax information, and there's a high level of risk if you don't know what you're doing investing in real estate. So here's that slide I just put together for you guys. So it was from a class that I took from Tom Lundstedt. He was a professional baseball player, from my understanding. I don't know. I don't follow sports, but from my understanding, from what I recall, he was a professional baseball player, and he came out with these with this class because he's really good at math and tax information, become a tax preparer. So he came up with this seminar. So this seminar we took, and I recorded it and made it available here for you. And the seminar has a booklet. Here's the booklet in the shared Google Drive as well. And if you want to take other classes directly from him, I have the resource right here for that. Ones that seminars. See, vesting and tax depreciation seminar. Okay, this was from 2021. All right. What are some of the advantages of real estate? Now we're going to highlight those. We had it on the previous slide. Now we're going to highlight them right here. So therefore, I'm going to shuffle these slides around. So this goes after.
We're good.
Well, I'll actually put this slide at the end of the chapter, the seminar. Okay. This is on 327, 328 right here. You guys got those highlights?
One sec.
Okay.
Okay, got it.
So there's different ways the real estate investment can yield a return. Property can be held for appreciation using inflation as a hedge. Real estate's generally expected to increase in value over time if you hold it long enough and do nothing to it. Income property, you could use it by charging rent and collecting income from that rental income, as well as profit on the eventual sale. Cash flow, that's spendable income after expenses. These are now some of these investor terminology lingo that we're going to learn. Cash flow is spendable income after expenses. We're going to learn about pyramiding through refinancing. That's when you keep refinancing the property, draining all of your equity out of it to use it as a down payment to purchase another property. And you keep doing that over and over again. So even though all your assets will be highly mortgaged, you could find yourself owning millions of dollars of real estate in a relatively short period of time by doing that. And equity is the difference between the market value and what is owed on the property. So here, let's highlight cash flow. The object of owning income property is to generate spendable income called cash flow. Now here's some tax breaks for home sellers. The tax benefits for the sale of your primary residence. You know, we should always refer people to their accountants, CPAs, and tax attorneys for advice on their taxes. However, both the federal and state governments, we learned about this in the chapter 8, which was about taxes. Both the state and federal government have capital gains tax exclusions from the profit of the sale of your primary residence. You pay no income tax up to a certain dollar figure. So of profit from the sale of your primary residence. So if you own and occupy a property 2 out of the last 5 years before you sell it, single filers can enjoy a $250,000 tax-free capital gain. So usually you got to pay taxes on your capital gains for any investments. But for your primary residence, if you lived in it 2 out of the last 5 years before you sold that investment property or that property that you're living in, if you're a single tax filer, meaning you're a single person filing your taxes on your own, or you're a married couple but you file your taxes separately, you get up to a $250,000 capital gains tax exclusion from any profit on the sale of your primary residence. Married couples filing get up to $500,000 capital gains tax exclusion. Now, if the owner lived in the home less than 2 years before selling, the IRS may still allow deductions if forced to sell due to a hardship. Hardships include job loss or transfers. That would force the early sale of your home. And that wasn't because of you, so they still extend you that benefit, you know. For health reasons, death, divorce, or multiple births, they consider these hardships that would require the forced sale of the property, so therefore you could still get those benefits. And you could reuse them as often as every 2 years on another property, because you have to live in the property 2 out of the last 5 years. So you live in the property for 2 years, you buy another house, you move into that. So you rent it out for a couple of years, and then you go sell it at a profit, and you pay no income tax up to the $250,000 or $500,000, whichever one applies to you. And then you're living in the other house, you could keep doing the same thing every 2 years. Sellers must pay income taxes on the profit of a sale of an investment property, but not for a primary residence, one that you are living in. So, if you have investment properties, there's a way for you to avoid paying tax on the property. It's not avoiding it altogether. You'll eventually pay taxes when you finally sell off the investment property. However, if you sell an investment property and then you buy another investment property, you could avoid paying those income taxes on the profit if you reinvest that money. There's a section in the IRS tax code called a 1031 exchange. So on page 329, where you see it says exchanges, write 1031 above that. 1031 is the section in the IRS tax code that allows a tax deferred exchange. That's basically what it is. So real estate investors can defer taxation on capital gains, the profit of a sale, by a like-kind property exchange. However, it must be of like-kind investment. That is, the income investment property. For example, a landlord moving across the country wants to sell an apartment house and buy another. They could do that. That she can manage in a new location. If she, okay, so the investor is a she, and if she has to pay capital gains tax on the sale of the present building, she won't have enough left to reinvest in a similar property. So that's what the 1031 exchange is. You don't have to pay the taxes because you're deferring it. You're reinvesting all that money back into a similar like-kind investment. So Section 1031 exchange, also known as a like-kind exchange, allows an investor to sell one investment property and buy another outright. The investor must identify the intended purchase within 45 days of selling the first parcel and complete the purchase within 180 days. And when the property being bought, the replacement property costs less than the one that's being sold, difference in price is known as boot. I'll just highlight all this stuff. I got a slide coming up that I'll explain it all of that a lot easier. Everybody got those highlights?
Yes.
Yo, so, here we go. Here's your slide. Everything you need to know about 1031 exchanges. The seller must pay income taxes on the profit of the sale of any investment property, but may get a capital gains tax exemption for a primary residence. A 1031 exchange allows an investor to defer paying income taxes on the profit of the sale of an investment property if they reinvest it in another similar like kind investment property. They wouldn't have to pay the income taxes until they eventually cash out and realize the gain when they sell it. So there's strict timelines that must be followed to qualify for the tax deferment. The strict timelines must be adhered to, otherwise the investor will lose the tax deferment and must pay capital gains taxes on the sold investment property. So first of all, get a tax attorney or CPA to do the communications with the IRS and notify them that they're going to be doing a 1031 exchange. Then you must notify the IRS that they'll be doing an exchange at the time of the sale of the current investment property. Then the IRS gives the investor 45 days to find and locate a replacement investment property that they wish to purchase after selling the first property. And they get a total of 180 days to close on the purchase. It's not 45 days to locate a property plus another 180. It's 180 days to accomplish it all, to locate the property and close on it. It's just that they got strict deadlines. You have 45 days to find another investment property. Notify the IRS what that property is. Then continuing on in 180 days in total to actually close on that investment property. Otherwise, you lose out and you can't do the tax deferment. So we need a team that's aware and sensitive to these timelines, that we can't stall anything. We got to move things along. And boot is when the replacement property costs less than the sold investment property. You're not you're cashing out on some of the profit then. And that difference in value is known as boot, and boot is loot, and all loot is taxable. It's a capital gain. So, capital gain is taxable profit on an investment. Simply put, basis is that investor lingo again, is an investor's initial cost for their investment. In this case, it's real estate. And the adjusted basis is the basis price plus improvements. So the basis is your initial cost to purchase the real estate plus any additional money you put in to do improvements. Keep track of all that. You add your initial cost to buy plus the money that you dumped into it. That's called your adjusted basis. So when you sell the property, you could subtract the money that you put into it to purchase it. So you're not going to get taxed on that. Anything above that would be profit. That's what you get taxed on. So highlight capital gains, taxable profit on an investment, and the basis of a property is the investor's initial cost for the real estate.
You got it.
So loot is loot, and all loot is taxable. So when doing a 1031 exchange and the replacement property costs less than the sold investment property, the difference is boot, and boot is loot, and all loot is taxable. So you take the basis, say the initial cost of the real estate was $300,000, and then you dumped another $100,000 into the property. The adjusted basis is $400,000. You guys understand now how to calculate it? It's pretty simple, right? Now, if you sell that property for $600,000, there's a $200,000 capital gain that's taxable if you just cash out on it right now, right? However, if you were to reinvest that entire amount in another income property, another investment property, you could defer paying any taxes on that. But if you don't reinvest the entire profit of $200,000 into another investment, let's just say you're buying a replacement property that costs $500,000. Since it costs less than what your total is that you're getting from the sale of your current property, there's a $100,000 difference in price. So you're cashing out half of the profit on it. So you'll have to pay income tax on that $100,000 that you're cashing out, because you didn't reinvest the entire $200,000, only $100,000 of it. So $100,000 is taxable, the other $100,000 is not. It's deferred until you eventually sell that replacement property. If you don't do another 1031 exchange, if you just sell it to cash out and retire. Okay. So depreciation, we learned, is a loss of value to any cause, due to any cause or condition. Well, in this chapter, depreciation is used as an accounting concept to deduct the cost of an investment over a period of years on your taxes. It's not a reflection of an actual loss of value on the property. It's used to reduce your taxable income before taxes are computed. You know, if you're running a business, you buy machinery for that business, you can write off the cost of the machinery. Like, you need a tool. You're a plumber, you need a tool to do your plumbing job. You could write off the cost of the tool against any income you make in that year that you bought it. Or if you bought a bunch of tools, you could write off the cost of all those tools. You guys are getting started in real estate. You're going to need some tools, maybe a new cell phone or a tablet or laptop or a camera or whatever it is, whatever the costs of something that's needed to run your business. The website, you're going to need a real estate website. Okay, that's an investment. That's a tool that you're going to have, right? The cost for that website, you could deduct on your income taxes against any income that you have, reducing the cost of your overall income that can be taxed. So if you make $100,000 a year and you spend $5,000 that year on a real estate website, it reduces your taxable income to $95,000 instead of $100,000. Okay, that's the way that it works. And then you calculate your taxes based on that reduced amount. So for bigger ticket items, like a vehicle, that needs to be deducted over 7 years. For real estate, it has to be deducted over a longer period of time. You can't write off the cost of the real estate all in 1 year against the income that you make. Or the same thing with a vehicle. Larger ticket items, the IRS has rules that you can't write it off completely in 1 year, like the car or a van. The plumber needs a van. He buys a van for his job. He can't write off the entire cost of that van in 1 year against against his income. He has to depreciate it over a period of 7 years. So the cost of the van divided by 7, and that's how much he could reduce his taxable income by every year before he calculates his taxes. So with real estate, though, it's an even longer period of time. Whatever the assets, so a property's value cannot be depreciated or deducted all at once. The asset has to be depreciated over a period of years, whatever its life expectancy is as defined by the IRS. So the value of the land cannot be deducted. Why? Because the general rule is land does not depreciate. So therefore you can't deduct it either, except in extreme circumstances like pollution or whatever. Now, the economic lifespan of an improvement refers to the IRS's defined lifespan. So on residential property, it's 27 and a half years, 27.5 years. On commercial property, it's 39 years. So whatever costs to purchase that property, you got to divide it by those number of years, and then you could write that amount off on your taxes each year. I'll give you a math example on the next slide. But you got a good explanation there. Oh, actually, not on the next slide, the slide after. Okay, so here, I want you to write next to the title, depreciation, economic lifespan of an improvement, because that's the way it'll be worded on your state exams. Maybe on the school exam too, not sure. But state exam, definitely, they refer to it as instead of saying depreciation, they say the economic lifespan of an improvement. So here's an example of a question like they could ask you. If a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? Yeah. So I'll show you how to figure out this math problem on the next slide once you guys have these highlights and notes. Let me know when you do. Y'all have the notes?
Yes.
Yes.
So here's how you do that problem. Here's the question again. And here's how we break it down. So the total property value's $500,000. The land cannot be depreciated, so you have to subtract the value of the land from the total property value. And the improvements value then is $350,000 through that calculation. Now that $350,000 cannot be deducted in 1 year. It has to be depreciated over, the asset's economic lifespan, in this case, 27.5 years. So you divide it by 27.5 to get $12,727.27. That could be deducted. You can deduct from your total income before you calculate your taxes. So that's how you would reduce your taxable income there. But that's not what the problem said. The problem said how much would be depreciated over 3 years. So we're not done yet. We need to multiply that by 3. And that's the answer. So if you get a problem that's worded like that, don't stop there. That's not the answer yet. That would be wrong. The question asked how much would be depreciated over 3 years. So don't forget to multiply it by 3. Don't just stop right there. Multiply it by 3, and that's the answer. That's how much could be depreciated over 3 years off your taxes.
So if you live in your house for 27 and a half years, there's no more
This is not for the house you live in. This is for your investment
Oh,
property.
this is an investment property. Sorry.
Yeah, because
Okay.
remember, the house you live in, you get that total capital gains tax for state and federal law, from the profit up to 250,000 for single filers and up to 500,000, 500,000 for, married couples who file their taxes jointly. So this is only for your investment properties that you may have.
So for your primary residence, you're only getting the tax break when you sell it. The investment property, you're getting this depreciation every year.
Yeah, actually, yes, yes,
Yes?
yes.
Okay.
Actually, I'm sorry. I actually stated this wrong. Yes, you can deduct this, for your primary residence as well as investment properties.
Yeah, because I thought 27 years was for your primary.
It's
At
for
39
resident. No, it's for
resident.
resident. It's whether
Oh,
it's not.
residential investment. Okay, sorry.
Yeah,
Residential investment
yeah.
versus commercial investment. What?
Correct.
Okay, a mixed use property is considered commercial, a commercial investment.
Yes.
Okay.
Okay. Now, I told you I misstated over here. I told you no, this is only for investment properties. Well, no, you could deduct this on your residential too, on your primary residence as well, each year off of your property taxes. I mean, who's to say that your primary residence is not a investment, a long-term investment, right?
Right. So then my initial question was after you live in your primary residence for 27 and a half years, there's no more depreciation.
Correct.
Okay.
Unless you dumped any more money in it over the years.
Um,
You know, the value you uh
does it increase at the year that you put more money in?
if you're increasing the value of your improvement, you
Uh-huh.
put more money into it because it's based on the value of the property, right? So you put $500,000, you bought this property for 500,000. You have to subtract the value of the land, but then you could deduct what you paid for the improvements value. Now, if you had to put more money over the years, well, then that increases you got to keep track of this stuff. Then that increases your investment in there that can be depreciated.
But it still stops at 27
Correct.
and a half years.
Correct. Correct.
Like if you're in the house for 10 years and you put $200,000 in it, it's not like you lost that 10 years of depreciation. It's not like you're going to add more on now because you put $200,000 in after you were in there for 10 years.
The total asset can be depreciated over the period of time. So
you're still adding it to
the math starts getting a little complicated when you're putting money into it later on, but that's why we just need to know the simple, when you initially buy the property, this is the rule. As far as adding money in later, that's why we get accountants to figure this out. Right?
Yeah, I'm just trying to understand how it works. That's fine.
Yeah, yeah. I'm sure you could ask AI, you could ask your co-pilot if you have a Windows computer on Windows AI, and it'll help you out there. Here, actually, let me just make sure I'm giving you the right advice on this as well. So let me minimize that slide for a second and talk about let me ask. Properties, gains. Okay. Value and improvement value. Can be depreciated tax. period of year. That apply to primary. Let's make sure I'm giving you the right information here. Okay, so the answer is no. You can't, it's only for investment properties. I was right initially. Yeah, it's not for your primary residence. Unless your primary residence is multifamily house or mixed use property, because now, even though it's your primary residence, it's also an investment. You follow?
Yes.
Okay.
Got it.
You good?
Yes, thank you.
Okay. All right, so 38,181.82 would be the answer on that problem there. And so that's the amount that has been depreciated over 3 years, as the question asked. So the per year amount can be used to reduce the taxable income before your income taxes are calculated each year for the next 27 and a half years for residential property and 39 years for commercial property investments. Okay. Sorry about that confusion there. All right, so the federal tax law limits the deductibility of losses from rental property. The first $25,000 of a loss can be used to offset income from any source, not just income from that investment property. The investor must actively participate in the management of the operation of the property. They call it sweat equity. You know, like instead of hiring a landscaper, you're cutting the grass or taking the garbage out, you know, stuff like that. So, or you're doing some repairs on the property instead of hiring somebody to do it every time. So you put in some sweat equity, then you can get additional deductions there. So and your taxable income has to be less than 200,000 before the deduction's made. Okay. So tax credits are a little bit different. Tax credits are more valuable than tax deductions because a tax credit's a direct reduction in taxes due rather than a deduction from your income tax, from your income before the tax is calculated. So it ends up being a dollar per dollar credit. And I'll do a math problem side by side to show you how that savings would actually work out. Not that you need to know how to calculate this for your exams or anything, but you do need to know that a tax credit is more valuable than a tax deduction. Okay. Now here they give you examples for when do people get tax credits? You know, so a tax credit. Let's see. So older buildings or renovations and low-income housing projects can use tax credits to offset taxes up to $25,000 on other income. Even passive investors can take advantage of this tax credit. The maximum income level at which the credit can be taken is also higher. Investors with adjusted gross incomes up to $200,000 are entitled to a full $25,000 offset, which reduced by 50 cents for every additional dollar of income, eliminated entirely for incomes over 250,000. This is how your tax preparer will calculate it. Now, tax credits have been provided for taxpayers who renovate historic properties as well. Historic properties have to be designated by the Department of Interior and listed in the National Register of Historic Landmarks or property of historic significance. You know, like this battle was fought here, or George Washington slept here, or something like that, you know, and is a state certified historic district, in a state certified historic district, the allowable credit is then 20% of the money spent on any renovations. Now, the work must be accomplished in accordance with the federal historic property guidelines and certified by the Department of the Interior. After renovation, the property must be used as a place of business or rented. It cannot be used for the personal residence of the person asking for the tax credit. There's a credit also of 10% of rehab costs on non-historic buildings that were placed in service before 1936. Non-historic buildings must be non-residential property, so once again, commercial. The law also provides tax credits ranging from 4 to 9% each year over a 10-year period for expenditures on new construction or renovations of certain low-income housing. And we seen when we had the mortgage market meltdown of between 2006 and 2009, when the real estate market was crashing, politicians kicked into gear in their arrogance, thinking that they could solve all of our problems by throwing money or tax credits at it. So politicians said, we know these properties are overestimated and overinflated in value over the years because of nonsense that we did that caused them to inflate in value at a tremendous pace. However, that bubble burst and the values started to fall. So we're going to come to the rescue and fix the problem by offering a tax credit so that we could incentivize buyers to rush out and buy real estate in the marketplace, because that'll stop property values from dropping by getting enough people to go out and buy property. Huh? If enough people rush out to buy property, yeah, that'll stop the values from dropping like a brick temporarily. And they actually did this. Taxpayers who, the government offered that stimulus to rush out, and they would give you a $7,500 tax credit. So a lot of buyers, they were like, I don't know about buying real estate when the real estate prices are falling like a brick. However, $7,500, we got to be near the bottom now of the market crash. It's kind of a gamble. And you're incentivized by politicians to do it. So a lot of people rushed out in 2008, 2009 when this $7,500 tax credit was offered. And they ran out and they bought real estate. And it kind of, sort of, flattened the curve a little bit. Okay? You guys know about the curve with the whole COVID thing, right? How that works? Well, the curve, for the real estate markets were declining. Okay, here, let me focus on me here. So the real estate prices are now crashing and the prices are falling like a brick, right? They're falling, they're falling, they're falling. We offer an incentive to get a bunch of buyers to go out and buy, and then that curve starts to flatten. But not completely. And then after that incentive for people to rush out and buy houses, the real estate market started crashing again. So the politicians just incentivized a bunch of people to rush out who were not in financial dire straits to buy real estate, that then the values started dropping like a brick again. So did they have the solution to the problem? No, they did not. Plus, there was a little catch to it. You couldn't sell the property within 3 years. You had to hold on to it for at least 3 years before you sell it. Otherwise, you got to pay back that tax credit to the IRS. And so when people bought those properties and the value started dropping like a brick and kept going down and down, people were like, oh, shoot, I got to get out. They sold the property. They sold them for less than what they owed. So we negotiated to do short sales with their lenders, and their lenders let them off the hook for that loss. But then we heard that's the IRS knocking on the door with their hand out. We want our $7,500 that you owe us because you sold that house in less than 3 years. So did politicians have the cure to this problem? No. They actually pulled more people into dire financial straits that were not having financial issues before. But don't worry, the politicians were not done yet. They said, well, we did flatten that curve. Kind of. You know what the problem was? We didn't throw enough money at it. So in mid 2009 to 2010, they offered another $11,000 tax credit this time to stimulate people to rush out in the marketplace and buy that real estate. Oh, so did they cure the problem? Well, yeah, more people said, okay, well, before and now, a lot of time has gone by. We got to be near the bottom now. And $11,000, that's a pretty big tax credit. That should buffer the fall of any more in value. So a lot of people rushed out and bought real estate. So that curve was almost completely flattened, almost completely flattened. Until the end of 2010, when the tax credit went away. And then the property value started to drop again. And then people rushed out, did short sales in a panic. And then the IRS came knocking on the door for their $11,000. And if you didn't have it to pay them, plus late fees and penalties, compounding. So those politicians really screwed up a lot of people's financial lives with their solutions to fix the falling prices of real estate, which were inflated due to their own actions. See, this is why being aware of politics and not just having a party favorite that you're either Republican or a Democrat, or you don't have your favorites. You actually just pay attention to what's actually happening. What are these politicians actually doing for us? It's funny how many people that they agree with you when you say that. Yeah, you got to look at what the politicians do if they're actually helping you to determine if they're any good, right? But if you're on Team Democrat and it's a Team Republican it's a Republican that's doing it, it's no good. That's stupid. Doesn't matter if it's a Republican or a Democrat that's doing something good. As long as what they're doing is good, truly, genuinely trying to help the people. If it's not, doesn't matter what side they're on. If they're actually doing something to help, you can't be. I shouldn't say you can't be, because people are. You condemn politicians when they're doing bad things, not when they're trying to help and actually doing good things out there. So there was a politician called Barney Frank. You guys remember that guy, Barney Frank? He's retired now from Congress. I forget if he was a senator or a congressman, but he's retired now. Although he shows up on these political shows on TV every now and then. And they pretty much rewrote history because, who controls the search engines and a lot of these websites that they get the information from. They kind of rewrote history. If you were to Google it, it kind of makes him look like a hero for saving our economy when the market was crashing. Actually, he's the cause of why it crashed to begin with. He was the head of the banking commission. So he was in charge of the regulators that made sure that banks adhered to their rules, that all the laws and the rules that the politicians create for banking. And, there's a lot of rules out there, everything from anti-discrimination. You can't turn people down for loans to discriminate against them. When people get approved for loans, it's based on objective criteria like their credit score, their debt to income ratios, stuff like that, right? Well, Barney Frank actually had a hearing. I remember watching it on C-SPAN, you know, the boring programs where you hear politicians, talking. And he was actually grilling his own investigators, the regulators of the banks. And he was asking them about banks and how come they're not writing more loans to poor people and minorities. And, the regulators, the investigators explained, well, it's against federal laws and state laws to discriminate against people because of their race or color or what have you, if they're a minority. You can't discriminate when giving loans to people based on those factors. They use things like your debt to income ratio to figure out how much you could afford to borrow, and your credit score to see your likelihood of paying it back on time. And he was like, I didn't hear any of that. If banks don't start writing more loans to poor people and minorities, I think they're discriminating, and we're going to come down heavy on them with fining them and maybe even revoking their banking licenses. And banks listen to these things. They listen to these boring hearings, and they're like, say what? What'd you say? You're gonna heavily start fining us or revoke our banking license if we don't give more loans to poor people and minorities? Oh, that was the incentive for the banks now to give more loans to poor people and minorities so they don't get their fines or their licenses revoked. So, how do you give more loans to poor people? Let's figure that one out first. I mean, they're qualified for what they're qualified to borrow. If they can't get enough to buy a house, they are not qualified for that because they have low income and maybe higher debt. So how can you make these people qualified to borrow more money to buy a house?
Zero money down.
You lower the lending standards in a nutshell, right? I mean, well, zero money down is one way of doing it. Or how about stated income, stated assets? You remember that one? You only needed to tell the lender how much money you make and how much long-term debt you have. You didn't need to verify it with any supporting documentation. You didn't have to show your tax returns or your bank statements. Those were types of loans called stated income, stated assets. And they're making a comeback again, which blows my mind. So you just tell them how much money you make. So is there any possibility for something to go wrong there? You think people may lie about their income just so they can borrow more money to buy a investment property in hopes that the investment property pays for itself? And, because if it goes empty and God knows the person's not going to be able to afford it. But hey, as long as you got renters in there, you can, and that's your opportunity to have investment properties, right? So did you have bus drivers claiming that they made $300,000 a year? And they were given those loans. So after a while, they're like, they had to put an end to it. They were like, okay, these rules are changing a bit. Well, the banks were like, this is getting out of hand. So they're like, the stated income has to be within reason. I mean, it has to be within the spectrum of a bus driver's possible income with the highest paid job, okay, as a bus driver. So it has to be within reason of that in order to claim that kind of income. So banks started to crack down on that a little bit. They said, okay, well, even though you don't need to show proof, your income needs to be within reason. All right. So that's how you do it. You lower the standards for borrowing. Now, if you lowered the standards for those poor people who previously could not afford to get a loan to buy real estate, what does it do to those who already could afford to get a loan to buy the real estate? It means that they could borrow more money. And home buyers out there could borrow more money. What are home sellers going to want for their homes? More money, right? I mean, is this not common sense? Am I saying something that's off the wall, or is this all like within reason? You know, I mean, if buyers can afford to pay more, sellers are going to want more, and they did demand more. This is why real estate market prices started shooting up. And then, okay, now how do we address giving more loans to minorities? So that's the poor people, how we got them covered. Now, how do they give more loans to minorities? Well, now you got to start targeting them with your advertising in the place where minorities, maybe the magazines or the TV channels, or in neighborhoods with high minority populations. The lenders were targeting them for loans. They started sending them, they had billboards, television, magazines, mailings to their houses based on their demographic, you know, as a minority. So they were giving more so that they could give more loans to minorities. Okay. See, later on, when the real estate market started crashing, like when it was still going up and they were giving more loans to poor people and minorities, hey, everything's honky-dory. Everything's fine. But later on, when the real estate market started to crash and then people started, you know, trying to sell the properties, doing short sales, trying to get out of it, and it ruined people's financial, credit. They started calling this predatory lending. Why? Well, because they were hunting down poor people and minorities to give loans to that were not going to get them otherwise. They were targeting them with their advertising. It's so evil, targeting them. Okay. Yeah. In hindsight, it's easy to say that. But while they were targeting them, the poor people and minorities, they were gladly now learning that they could get loans, and they were getting them. But it's funny, when your financial situation all of a sudden now starts crashing, they're evil for doing that. Before, they were thankful that they got the loans so that they could get into the real estate, but now you're evil. It's predatory lending. So that's where this terminology comes from. And it's quite interesting to just see the human behavior and what people remember and what they forget so selectively. And those people that were rushing out and they were getting loans, some people were getting these adjustable rate mortgages. Adjustable rate mortgages, what are they? You know, the interest rates adjust on them on an annual basis, right? You guys went over that in chapter 14 and 15, right? Adjustable rate loans. And so a lot of people, if they go out and they get an adjustable rate mortgage, they also had hybrid mortgages that they were fixed rate for the first couple of years at a teaser rate that was really low, and then it becomes adjustable after that. So if the rates go up, you're going to pay a higher mortgage payment. The rates are not like with a fixed rate loan where your first payment through to your last is the same. With adjustable rate mortgages, if the interest rates go up, you pay more. If the interest rates go down, you pay less. If they're fixed for a certain period of years, but that's the maximum amount that you can afford to pay, why would you get an adjustable rate mortgage knowing that rates are going up or could go up? And when they do go up, you're not going to be able to afford the payment because you're already maxed out at this teaser rate. That's a low just to get you into the housing. Why were people getting those loans? Well, they're like, well, as I build equity, I'll just refinance into a fixed rate loan. Sounds like a good idea, a good strategy, right? As long as your property value doesn't fall. Because who's going to give you a new loan? What is refinancing? It's a new loan that pays off your existing one. Who's going to give you a new loan to pay off your existing loan, which is now more than what the property's worth once property values start falling. Don't you get appraisals for that reason, to make sure that the property's worth at least what they're lending you? Because they're not going to lend you more than the property's worth. So people were unable now, when the real estate market starts crashing and they got a loan that's this much, but their value of their property is this much, the lender's not going to loan them to refinance to a fixed rate loan this amount up here that's much higher than the value of the home. So if they should have to foreclose, they'd never get all their money back. So people were then losing their homes to foreclosure. Remember, we had the whole foreclosure crisis? Well, that's why, because people were unable to refinance. And restructuring the debt was an option that they were tossing around there too, but most of those didn't work because they don't forgive any of your principal that you borrowed. All they do is they stretch out the loan to maybe 40 years and to try to get your payment down and be more affordable to you. So most people, it didn't work for them. And they lost their homes. There's a movie that came out about this called The Big Short. Anybody ever hear of that? Check it out. The Big Short. Let's see. So a movie called The Big Short was released, which talked about what led to the housing market inflation and crash. Now, they didn't talk specific politics or political parties or political persons involved in this. They kind of skipped to the point where the real estate market was booming and then the impending crash and stuff. Okay. So The Big Short was about investors investing in shorting the mortgage market. Okay. If you guys are familiar about buying stocks, you could purchase stocks at a low price, hope that the value goes up, you sell it at a high price, you make money, right? Everybody knows that, right? You buy low, you sell high, right? Everybody familiar with that concept? Buy low, when the price goes up, you sell high. Then you make that money in between. That's all profit. But did you know that when you could buy stocks in something that's called shorting the stock? When you short a stock, you're gambling that the value of the stock is going to go down. And if it goes down, you make money. So these investors, they were like looking over the possibility of shorting the mortgage market. And they're like, no way could this possibly happen, because there's so many safeguards in place in our country, from federal government, the feds will step in, there's federal regulations, there's banking regulations, there's all kinds of regulations and safety valves and checks in place that this would never happen. So shorting a stock or the market for mortgages, that's a bad investment, because there's so many safeguards in there to prevent that from happening. Or so they thought. Those safeguards, the politicians were just ignoring. And that's what led to our mortgage market meltdown and the real estate market crash of 2006. A lot of people say 2008 or 2009, but that's when it really ramped up. But it actually started to peak out and the market started crashing in 2006. So take a look at it. If you haven't seen it yet, write that down. The Big Short. Check out that movie. It's got a lot of it's a star-studded, star-packed movie there. All right, let's look at now. I told you I'd give you a math comparison of a tax credit versus a tax deduction. And I told you the tax credit will save you more money. So in this example, we're going to do a side-by-side just so I could show you how it's better. So we're going to compare a $15,000 tax deduction versus a $15,000 tax credit on somebody who makes $100,000 income in a 15% tax bracket. So You got $100,000 income. You subtract the tax deduction before you calculate your taxes. So now you have $85,000 of taxable income. So now we calculate how much in taxes you're going to pay if you're in a 15% tax bracket. And now you owe $12,750. Okay. Now, tax credit, if you calculate your taxes first, not after. So if you have $100,000 income and you're in a 15% tax bracket, you owe $15,000. But you got a tax credit of $15,000, so at the end of the day, you owe nothing. You see how a tax credit is more valuable than a tax deduction? So, land contracts, we learned about this before, sometimes referred to as an installment sales contract. We learned about it in chapter 11, page 220. So land contracts, also known as an installment sales contract, the buyer makes payments in installments and waits for the deed. It's a type of seller financing where the buyer has a financial interest in the property called equitable title, but they're not the owner until they pay off the full amount owed. There's complex tax rules to see what you could deduct on your taxes with this. So it's figured on the investor's marginal tax rate. So let the tax man figure it out. That's not for us. We're not the tax experts. So real estate investment syndicates are a form of business organization. It's not a legally formed business entity. We learned about this, I think, in chapter 6 or 7. To carry out a business project. So when the project is done, the business entity is then dissolved. So syndicates are joining together of 2 or more people to carry out a project. Joint venture is a joining together of 2 or more groups to carry out a project. So a real estate investment syndicate is a business venture in which the group of people pool their resources to own or develop in a particular piece of property. Who says it's a REIT, real estate? No, sorry. This is a real estate investment syndicate. So so it's a couple of people, little ladies, they gather their money at the table and they all buy an investment property together. That's a syndicate, a real estate investment syndicate. 2 or more people, they come together to carry out a business project. Okay. So here's a warning for you guys, because you're going to be helping people, investors, identify good investment properties for them to purchase. You're going to, after a while, you're going to get the eagle eye. You're going to see what investors look for. And you're going to be able to spot a good investment a mile away, only if you had the money. So then you're going to have this bright idea that, hey, maybe I could put an ad out there and try to get investors to invest in a real estate project that I will own, but in return, I give them something in return, right? A return on their investment, a profit of some sort. Share with them a percentage. Well, this could be classified as a security. Okay, so this could be classified as a security. So you could get into trouble, especially if investors are not familiar with real estate investing and they lose money. Hell, you end up going to jail over something like that. So special licensing is required to deal in securities. The investment must be registered with the FTC and the SEC, the Securities and Exchange Commission and Federal Trade Commission, as well as New Jersey, which has blue sky laws that regulate these things, the sale of securities. So such offerings must include a prospectus prepared warning potential investors of the possible risks involved, not just selling them on the possible upsides and the profits. So this is why we don't have that license. So you could do this if you get a person involved that has that license to deal in securities. And then you have the real estate license because it is real estate. So you're going to need both license types. So partnerships, we have general partnerships and limited partnerships. Remember, we went over this in chapter 7. All members share in a general partnership. All members share equally in managerial decisions. So they work in the day-to-day business, and they share equally profits and losses. So they can be held liable for any additional debts the business takes on. All members of a general partners are general partners that work in the day-to-day business activities. In a limited partnership, there's always at least one general partner who works in the business and responsible for the day-to-day activities of the business, and any loans the business takes on, it is only the general partner that can be held liable for paying off those additional debts. The other investors are limited in their liability. They're limited partners. They can only stem to lose their initial investment in the business, not be responsible for paying off any additional loans that the general partner who works in the day-to-day business actually took out and isn't paying back. So the limited partners can't be held liable for that. REITs are real estate investment trusts, and they get the same tax advantages as mutual fund investors. So to create a REIT, there has to be at least 100 investors, and at least 75% of that trust income has to come from real estate as the investment vehicle. REITs usually invest in buying like large office complexes and apartment complexes with hundreds of units. You know, they're good, steady investments that pay out. You know, because as the tenants pay, it's profitable over the longer period. So that's a REIT. Who says you have to invest in mutual funds? Why not invest in real estate in your retirement? So you don't need to have a real estate license to sell a business unless real estate's involved in the sale of that business, where you need to sell or negotiate a lease, sell the property or negotiate a lease. But then it doesn't matter. We still just do the marketing of that. It's the attorney that handles the actual contracts. All right. So besides title to the real estate or a present lease, an attorney would be needed to prepare the sale or lease contract and transfer the other business assets like the trade fixtures, stock or inventory, the business name, customer lists, goodwill, special rights like copyrights, patents, franchises, or licenses like ticket lottery machines, etc. So a person who sells or negotiates the sale of a business for others for a fee is required to be licensed as a real estate broker. The exception is when the business is sold without any real estate interest in any form. So in other words, you don't need a real estate license to sell a business unless real estate's involved. Yeah. The book words everything so backwards. You notice that? Okay. All right. So financing the purchase of a business, you got to have a lot of money. And the seller providing a purchase money mortgage for the balance of the selling price of the real estate. The business purchase requires cash or personal loans. I like this. Page 334. Okay, so the Bulk Transfer Act is designed to protect sellers. Make sure you write sellers there. The seller's creditors from the fraud perpetrated by a business owner who sells the business, including the equipment and the stock, and then disappears, leaving those creditors unpaid. Yeah. So if you assisted them in the sale of that business without making that list of uh, creditors and notifying them that the business was for sale, and uh, and without notifying the buyer that you can't just say all the equipment and inventory is included in the sale when it hasn't been paid for yet. Here, just think of a convenience store for a second. A lot of creditors just come by and they stock the shelves with the candy bars and all the other stuff. And then they come in periodically and they do accounts of, hey, how many candy bars are left in the box? So they know how much has been sold and what the business owner needs to pay them now. Okay. Now, if that business owner puts the business up for sale, says, hey, everything's included, stock and inventory is included in the sale, it gives the impression that it's all been paid for, when it may have not. And so if they just sell the business and they don't pay back those creditors and just disappear, leaving them unpaid, well, you help them perpetrate that fraud if you help them sell that business. So make sure there's an attorney involved that could handle that part of it. So this way we could just focus on the marketing of the business to get those buyers of the businesses out there. Okay. So the requirements of the Bulk Transfer Act are designed to protect the interest of the buyers as well as those of the seller's creditors in the sale of the business. Real estate brokers and salespeople are never allowed to draw up contracts for any commercial transactions. Licensees involved in business or commercial sale should advise the parties to consult their tax experts and attorneys before committing themselves. Okay. So I wrote up here the definition. Let's see. The Bulk Transfer Act is designed to protect the business seller's creditors in the sale of a business. It also protects the buyer, but as a side effect, because they should be informed that all of the inventory and machinery or tools, the chattel of the trade, have not been paid for in full, and therefore can chase after the seller's personal assets to get reimbursed. So, what do you need to know for exams? You need to know the Bulk Transfer Act is part of the UCC, the Uniform Commercial Code, that regulates the sale of businesses. It prevents fraud in the sale of a business chattel. It protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying it's included in the sale, but it has not been paid for in full. Then the seller leaves their creditors unpaid. It's fraud. So the Bulk Transfer Act that covers this is Article 6 of the UCC, which is called the Bulk Transfer Act. And it regulates the transfer of chattel when selling a business. It prevents fraud when a business is sold. Okay. It requires the seller to make a list of all outstanding debts to creditors and supply that list to potential buyers and notify the creditors that the business is for sale. And real estate licensees must ensure that disclosures are made to avoid assisting the seller in committing that crime. In New Jersey, the Bulk Transfer Act protects the seller's creditors. Now, it also protects the buyers and their creditors, but as a side effect, kind of like homeowners insurance. Who does homeowners insurance protect? When you get homeowners insurance, who does it protect?
It's supposed to be the owner, but it
Is it?
seems like it's the insurance.
Well, when you buy a, well, hold on a second. When you buy a house, think about this for a second. When you buy a house, are you required to get homeowners insurance before you could close?
Yes,
Yes.
Who requires it?
the insurance company.
No,
What
the mortgage. I think the mortgage,
your
the
lender?
lender.
Mhm.
Why would your lender require you to get homeowners insurance? Well, because the property's not paid off, the loan's not paid off yet. And until that loan is paid off, the lender's going to require you to have homeowners insurance that insures that property that you pledged as collateral, so that in the event a truck drives through your house, or your house blows up from a gas leak, or it's on fire, or floods, that house that was put up as collateral, which is no longer worth it because it just blew up or was on fire or flooded or a truck drove through it. You need insurance to insure the collateral, which is the real estate, right? So your homeowner's insurance, at least until your loan is paid off, is put there to protect your lender. Now, the borrower's assets are also covered with additional riders for the estimated value of all your stuff that you put inside the house. So the real estate lender is protected by homeowners insurance, mostly. And as you pay off that house, you start getting covered as well. The more you pay down, well, now both you have equity in it, and the seller and the lender still has money out on loan, so they need that money's collateral, which is the house, to be insured. And as you pay down that loan, you're putting more money into it, you're invested in it, so it starts insuring you as well after a while. But it's mainly there to protect your creditors.
So
Next to
what if your
homeowner
house
as
is paid off?
what's that?
What if your mortgage is completely paid off?
Well, then it would protect you, because now if your house burns down, the insurance company will insure your home and fix it or pay you the money for a totaled house, right?
Hmm. Okay.
I mean, think about what it does and why a lender would require it. Hey, that house you pledged as collateral. What happens if it burns down tomorrow? We gonna be able to sell it and get all of our money back? No, not unless it gets fixed up again or rebuilt. And how are you going to do that? Insurance. You need to insure. So it's our responsibility as real estate agents to make sure that the home buyer is aware that they're going to need to get homeowners insurance before they close on that purchase. So we tell them a couple of weeks before the closing to arrange to start getting the homeowners insurance. Probably the advice. I don't even tell them where to go. I just say, "What do you got for your car insurance?" Contact them and see if they also offer home insurance. If they do, you could probably get a bundle deal with them. Alrighty, so I guess that was the last slide because I moved this slide about that tax seminar for investors. You guys can watch it. I put it on YouTube. You guys can watch it there. You need the link. Only people with this link can watch it. And here's the seminar handout booklet. So you'll need the link for that as well. So
because they have clients who want and need good investment properties. Last sentence, a good accountant, a good attorney, a good real estate agent, man, that's a great financial team. You're going to get some of your best referrals from accountants and attorneys once they realize that you understand this investment real estate stuff. Because the honest truth is, there are very
Can't see the video.
real estate.
Well, you could hear it though. I mean, what you're seeing on the video is just this, you know. But yeah, I was just playing just a little bit. I'm not playing this whole thing because it's 2 hours and 39 minutes long. It's a whole seminar. I gave you guys access to all of that, as well as in this seminar handout booklet. Okay, here's the booklet. Okay, real estate investing made clear, concise, and compelling. And he gives examples and worksheets so that you could work through it as he teaches the class, and shows you how you could calculate additional write-offs on your property, giving you all kinds of investment property worksheets over here, and how you could deduct more through bifurcation. It's actually a really good class. If you're an investor, you'd want to know about how to do this to get the additional tax write-offs on your business or on your investment property. Oh, shoot, I wasn't showing it. So here's that booklet with his disclaimer. And then you got, you know, analyzing rental properties before you buy them. He's got all these worksheets. And he goes through them, goes through all this. You could print this out and then follow along with watching the video in that seminar there. And he's got some case studies here as he uses as examples. And then it has the form all filled out here as well. At least these are the ones that I filled out. Sorry. All right. And that concludes chapter 17. Let's do the key terms to review for chapter 17 now. There are 2 of them. Cost plus improvements minus depreciation. Cost plus improvements minus depreciation. My shirt is purple. It looks like it's black in this video.
Adjusted basis.
Correct. One is the adjusted basis, your initial cost plus the money you put into for improvements minus depreciation is your adjusted basis. Increase in value.
Appreciation.
2 is B, appreciation. Appreciation. 2 is B. Initial cost for real estate.
Basis.
The basis.
Hmm.
You guys starting to detect the pattern here? 3 is C. The book manufacturer forgot to jumble up the answers and these key terms to review here. Documents transferring ownership of personal property.
Bill of sale.
4 is D. Extra money or property received by one party in an exchange.
Who?
And boot is loot and all loot is taxable. That's correct. 5 is E. A law regulating the sale and financing of business personal property.
Yep, Bulk Transfer Act.
6 is F, the Bulk Transfer Act. Taxable profit on the difference between the adjusted basis and the net selling price of an asset.
Capital gain.
7 is G, capital gain. Money left from rental income after expenses are paid.
Cash flow.
Cash flow.
8 is H, cash flow. Yearly bookkeeping charge for part of initial costs.
Yearly.
This is a horrible definition, by the way. 9 is I, depreciation. The tax.
What's it's a they define it as a bookkeeping charge?
Yeah, I told you, it's a horrible definition. I even have it written in my book here, next to it. Horrible definition. I actually got that written here in my book. Yearly bookkeeping charge for part of the initial cost.
Income. Oh.
Yeah, 9 is I,
Tax
depreciation.
yeah.
Okay, so tax deferred mutual transfers of income property.
Exchange.
It's an exchange. 10 is J. And 1031 exchange, to be specific, in the IRS tax code. Real estate held for rental income.
Income property.
11 is K. There you go, income property. All right, key terms 2. This one is mixed up, like it's supposed to be. Law regulating transfer of business personal property. What law regulates the transfer of business personal property that we went over last?
Uniform Commercial Code.
10 is A, the Uniform Commercial Code is correct. Refinancing property to buy more.
Pyramiding.
4 is B. Direct deduction from income tax due.
Tax credit.
9 is C. A joining together of 2 or more people to carry out a business project.
Syndicate.
Syndicate. 8 is D. Group pooling resources to buy real estate.
Real estate investment syndicate.
5 is E, correct. A rate at which investors' top dollar is taxed.
Installment sale.
The marginal tax rate
Mm.
is the rate at which investors' top dollar is taxed. 3 is F. A sale in which a seller receives purchase price over a period of years.
Return. Orders.
Installment sale.
Installment sale. 1 is G. Extensive use of borrowed money for purchases.
Leverage.
Leverage. 2 is H. A fund making real estate investments and selling shares.
Real estate investment trust.
A REIT, correct. 6 is I. Cash flow plus income tax savings plus appreciation. These are all examples of
Return.
a return. 7 is J. And that concludes chapter 17. So let me stop the recording on this one.